This video considers the second step in the five-step process towards accounting for revenue as contained in IFRS 15. The first step being you had to identify whether you had a contract with a customer or not, as that would then trigger the next steps in the five-step process. Otherwise, IFRS 15 is not applicable yet. This is perhaps the most challenging of the five steps, particularly for those in practice. This step involves identifying the various performance obligations that may be contained within a contract with a customer. At the inception of the contract, you need to have a look at the contract and identify what are the performance obligations in that contract. IFRS 15 doesn't define what contract inception is, but there is a standard IFRS 16 or the old IAS 17 that defines inception of a contract in terms of leases that you may look to for guidance on that. More importantly now though is looking for those performance obligations and how to distinguish between them. IFRS says that a performance obligation is each promise to transfer to the customer either a good or service or bundle of goods or services that is distinct, or a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. We'll consider both of these now in more detail. First of all, we need to look at, in Part A, goods or services that are distinct. To be distinct, there are two criteria that you need to meet. First of all, the customer must be able to benefit from that performance obligation on its own, and the performance obligation must be separately identifiable in the contract from the other promises. For instance, you may consider a maintenance contract that is sold with a new vehicle. The customer can benefit from each of these and they are separately identifiable in the contract. The second option of a performance obligation is a series of distinct goods or services. For example, consider a magazine subscription where a magazine is delivered at the end of every month for a 12-month period. IFRS 15 explains that a series of goods or services has the same pattern of transfer, and this is the case if it meets two criteria. The first of these criteria are explained in paragraph 35, which we will look at in the next slide. The second criteria is paragraph 39, which we'll look at in the slide thereafter. So in determining if a series of distinct goods has the same pattern of transfer, the first thing you need to consider is whether the control of those goods or services is transferred over time. There are three instances that this may occur in. The first is your magazine subscription scenario, where the customer simultaneously receives and consumes the benefits as the entity performs, so that the magazine is delivered and read every month over a 12-month period. The second scenario is where the entity is creating or enhancing an asset that's controlled by the customer. So, for example, the customer is building some other building, a shopping center or factory that's on the customer's premises, and all the construction as it proceeds is adding value to the customer's assets. Then again, it is over time. The third scenario is when you are developing an asset for a customer that is highly specialized and cannot be used for anybody or anything else. For example, very specialized software. So as you're developing that software, you cannot redirect it towards another customer at any point. Only the customer that you are targeting can use this. Then these will be a series of goods that are transferred over time to the customer. The second criteria then is that you measure it in the same manner as you transfer control across to your customer. Once you have now identified the performance obligations in the contract with the customer, satisfying that performance obligation will trigger your revenue recognition and your journal entries in the accounting records. If we look at an example now of identifying the performance obligation and the subsequent satisfaction thereof, consider the following. A Limited transfers two products, product X and product Y, to B Limited for 5,000 Rand. So you need to consider, are these distinct goods or a series of distinct goods? In this case, it appears as if they may be distinct goods. Payment, though, will only happen after product Y has been delivered, even though product X would have already been delivered. So revenue recognition will now already be triggered when control of product X is passed across to the customer. However, payment is not triggered until product Y is also delivered. So looking at the accounting for that in the journal entries, when the first of those products is delivered and control has gone across and you have now satisfied that first performance obligation, assuming that this product is a distinct good, then revenue is recognized. However, there is not a debtor yet. The reason for this is that a debtor implies that there is only the passage of time that still has to occur, for example, 30 days until you receive your money. In this example, that's not the case. You don't just have to wait for time. You need to wait for the next product to also be delivered, which is product Y. When product Y is then delivered, at that point there is only the passage of time that is waiting. And then you will see in your journal entry there, we now create a debtor or accounts receivable.